Hello and welcome to the Richard Hunter interview. As ever, this is a place where I'll be discussing matters of interest with a whole range of investment experts. And what better way to kick off the new format than with someone who needs little introduction. Nick Train co-founded Linsell Train Limited in 2000. He's the portfolio manager for UK equity portfolios, and it is the Finsbury Growth Income Trust, which is the subject of our interview today. Nick has over 30 years experience in investment management, and his approach is based on that of Warren Buffett's, involving building a concentrated portfolio of quality companies that have strong brands and or powerful market franchises. The bulk of these are UK companies, and this leads to a very different portfolio when compared to the benchmark FTSE All-Share Index. So first and foremost, a very warm welcome to you, Nick, and thank you for joining us.
Richard, thank you. I'm just slightly taken aback by the accuracy and succinctness of your description of what I and we do. I hope that's not going to make the rest of this session redundant, but I think I better go back and take some notes on that. That was accurate. Thank you.
Very kind of you to say. So perhaps we could start, Nick, in terms of Finsbury Growth and Income. What would you say are the objectives and the investment style of the trust?
Yeah, I mean, I know that this can be a cheap shot from professional investors, but you know, for me, I have to start with the observation that my personal holding in Finsbury and that of my immediate family, this is the single largest investment I have in a quoted asset. You know, I own my house as well, but you know, this is my and my family's largest single stock market investment. And you know, I have to say that does colour the way that I think about the disposition of the assets and indeed what the long-term objectives are that I'm working towards. You know, and I always take the view that you know, however simple it is to say this and difficult to deliver in practice, the objective of seeking at a minimum to preserve the real, i.e. inflation adjusted, the real after-tax purchasing power of the capital. You know, at a minimum, and that it's not a trivial thing to do actually over the decades, but at a minimum, that's kind of the mindset I've got when we're choosing securities. Now, I will also say, and just to reinforce your earlier description, the formal benchmark for this investment trust, and let me put it this way, the way that the board of this investment trust monitors our performance is it's compared against the long-term total return on the FT All-Share Index. So in other words, the UK equity benchmark. And personally, I do think that is a relevant measure. I think it is likely, not certain, but I think it's likely that if over time you can deliver a return in excess of that benchmark, quite possibly you will achieve those sort of more personal investment goals that I just alluded to earlier. So yeah, I've been doing this a long time, very long time, again, as you pointed out, and definitely a motivation to carry on is just that test of, can you do better than the market? You know, there are lots of very smart people trying to succeed investing in UK equities, and it's stimulating to see how it ends up for you at the end of any given period. You asked a question about investment approach. Did you? Sorry, I've been talking for so long already. I kind of forgot what the questions were. But
well, absolutely, and it kind of leads into the second question anyway, namely the kind of investment themes and maybe even secular trends you're looking at when you're investing funds into this particular trust.
Yeah, you did mention, the great Warren Buffett earlier, and let me just acknowledge yet again the influence of his thinking, his example on what I've done, what Michael Linsell's done, what other successful acolytes of Buffett have done over the decades. I think really what I'm saying is, for everybody who's got anything more than just a passing interest in investment, particularly if they're investing on their own account, do what I've done and take what Buffett says seriously, because even if the ideas that he was associated with 20, 40, 50 years ago maybe aren't so relevant today, the principles underlying them remain relevant. And I would say, just thinking about stylistic aspects, the two dominant differentiating aspects of what we've done, both of which are absolutely unapologetically copied directly from Buffett's advice, have been, number one, run concentrated portfolios. I think, you look at everything we do, you look at Finsbury, that's pretty much the first thing that strikes people. It is a concentrated portfolio. And the other Buffett-derived behavior, I suppose, is to discipline ourselves to try and transact as rarely as we possibly can, to keep portfolio turnover as low as we possibly can. Now, that is emotionally difficult, psychologically difficult, intellectually difficult, and sometimes it's plain wrong. It's plain wrong, not to do anything. It can be plain wrong. But using his example, in our experience, observing other successful practitioners, it does seem to us that you at least tilt the possibilities in your favor of doing well if you do that, or don't do that.
Yeah.
If you know what you're doing, and if you're prepared to ride the emotion, because my goodness, it's an emotional arena, isn't it? I mean, the start of the new year, just inspecting the scars that some of which haven't fully healed from 2020. I mean, this is tough. Anyway, sorry. So that's that. What are the big themes in Finsbury? Let me just outline those. We've got there's basically 3.5, call it, I don't know. Anyway, you see what you think. 3.5 or 4, as I would see them, substantive winning ideas. Certainly they've been winning in the past. Who knows what happens in the future, but there's 4 big winning ideas. The biggest allocation in Finsbury's portfolio, a bit over 40% of the portfolio, is invested in companies that have been, or we sincerely hope will be in the future, digital winners. So companies that can take advantage of this incredible, unprecedented, accelerating technology change that we see all around us. Companies that have got either a technology themselves, or they've got a product or service that's enhanced by the changes in technology. And we hope that that enhancement of their product or service leads to greater shareholder value, of course. So that's actually, I think, did I say just over 40%? That's the biggest allocation that we have. We've then got mid to low 30% invested in what I, as a shorthand, call beloved or trusted, or preferably both beloved and trusted consumer brands. Preferably, although not uniquely, preferably global consumer brands with opportunities to continue to grow into new markets, but also the opportunities to derive new economies of scale from becoming more and more global. And it's interesting. This has become perhaps a more controversial aspect of our portfolio over the last few years. I mean, I know people do question, and of course we think about this as well, question whether, I don't know, Johnnie Walker Black Label or Dove soap or Cadbury's chocolate, and others as well, but whether those kind of iconic brands that have been successful for, in some cases, centuries, but certainly decade after decade, can they remain relevant as we get deeper into the 21st century? Candidly, you can't be sure, but it makes, and maybe this is dangerous, but it makes me feel, what makes me sleep at night? Definitely one of the things that makes me sleep at night is knowing that we've got a significant allocation of this strategy to those sorts of brands that consumers evidently love or trust and have trusted for generation after generation. Moving on, and this is where I was wondering whether to say it's, 3 or 4. I mean, maybe associated with that second category of beloved and trusted brands. I mean, I've kind of split this out in my own mind. We've got another 16%. I'm sorry if this is ridiculously precise, but it is where the numbers are. We've got another 16% in companies that are luxury brands or clearly premium brands or aspirational brands. That previous bucket I mentioned, there are some mid-market, midstream brands within Unilever's portfolio, for instance. But I've separated in my own mind a block of capital that we've allocated to companies that really are luxury and premium. I guess our biggest single holding in this category, just so we're clear about the type of thing we're talking about, the biggest single holding here is Burberry. Obviously, Burberry evidently is the UK's only globally resonant luxury brand. And I felt it's important, just in terms of thinking about portfolio structure, to make that distinction, because I don't think there's any question over time the value over time, it seems highly likely to us that consumers around the world will increasingly turn to luxury and premium products, and finding companies that offer pure access to those sorts of products, that makes sense to us. This is a very, very long answer, but I've got one bucket left to fill Richard, if I may, just to complete where we get to the 100%. If you add it all up and subtract it all back down, then we've got just under 10% actually invested in my industry, I suppose, in asset management companies, particularly asset management companies with credible, I don't know if that's the right word actually, but asset management companies with important private wealth aspects to their business. We think, and this is because it's an industry, we're in it, we know something about it. Private wealth management, we think that is a growth industry, and that the provision of those sorts of investment services, not only is that a growing industry, but it's an industry that is also being benefited by technology change. You can provide much better information quality services to customers with the application of technology. I'm sure it's something that your business is investing heavily in. But there are also, of course, big efficiency gains as well from bringing technology to more and more of the working practices of companies like this. So, we have an investment actually that's done quite well for us over the last 12 months or so. We've got an investment in Schroders, where, that Cazenove Capital franchise, to us, that's a real jewel in that crown. That's the sort of asset we're looking for in that bucket of the portfolio. Just on that, the last thing I'll say on that final, just under 10% in those asset management businesses, and maybe this comes back to another aspect to the style, if you like. 30 years ago, I took a deliberate and conscious decision to always be bullish about equity markets, always, under any circumstances, always be optimistic about equities. And I've stuck to that. Sometimes being optimistic about equity markets has made me look and feel stupid, but actually over time, having that optimistic bias, I think that's been an important contributor to our long-term returns. At least you're invested when things do go up, because you're never going to time it. And I've always been attracted to, and by and large been rewarded by, having long-term holdings in successful asset management businesses. Because when economies create wealth, as they do over time, and when markets go up, as they do over time, asset management companies, they're a wonderful way to participate in that wealth creation. And so that's been a long-standing theme for us.
So given those parameters, and given the difficulties which you eloquently describe, of actually sticking to one of Buffett's sayings, buy and hold forever, despite that obviously being challenging at certain times. In terms of your top 10 holdings, for example, could you talk us maybe through one or two clearly that's going to fit into the kind of backdrop that you've already been describing?
I've maybe already mentioned one or two of these, but the biggest holding in Finsbury today, as has been the case for at least the last year, the biggest holding is in the London Stock Exchange. Past performance, of any security, of any investment manager, it's kind of irrelevant. But just in passing, I mean, we've got few instances more rewarding or representative of what we're hoping to capture than the long-term share price performance of the London Stock Exchange. I mean, without vainglory at all. But we first bought this in 2003, 2004 at £3 to £4 a share. Now 2003, that's a long time ago. But today it's trading at 92 quid, for a variety of reasons, but it's trading at 92. I mean, how wonderful, how wonderful. And, I think it's true to say that with the exception of portfolio concentration restraints on not allowing a given position just to get too absurdly big, we've never willingly sold a share in the London Stock Exchange, for 16 or 17 years. It has had periods of falling price or definitely underperformance, but yeah, it's been a great example of how owning a unique, exceptionally profitable business can create wealth for you over time. Let's hope that it continues to do that. There was a significant announcement yesterday, of course, about the approval from the EU of the combination with the old Reuters business.
Refinitiv, yeah.
What's interesting about LSE to me is that 10 years ago, I would have put the LSE in that bucket that I was just talking about, that sort of market proxy bucket. Actually, today, that holding in the LSE, I include that in our digital technology advantage bucket, because there's no question the London Stock Exchange is less and less a play on volumes or even the direction of the London stock market, but it's more and more a participation in the application of technology to reams and reams of data. And I think investing in the UK, frankly, has been, and you might say, well, it's self-imposed or whatever, but it's been a frustration over at least half a decade that truly globally competitive London-listed companies that are doing something valuable with technology and data, that they're rare businesses, particularly substantive ones. And I feel actually really, really fortunate that the London Stock Exchange is one of those, and it has been a major investment for us. The other holding, and I have mentioned this, or at least I've mentioned it in passing, and I have to say, whenever my friends or friends of my children ask me for a piece of investment advice, that the company I always advise people to invest in is Diageo. The world's number one spirits company, premium spirits company. Also happens to own the world's number one dark beer as well, Guinness, which is.
I'm familiar with Guinness.
Yeah, it's been a great solace, hasn't it? Guinness. I mean, as indeed have a number of Diageo's products. Listen, there isn't such a thing as a perfect company, and there are holes arguably in Diageo's product portfolio, and a company as diverse as this, both in terms of brands, because spirits brands do come in and out of fashion. And a company like Diageo that's so globally diverse as well, big positions in emerging markets, that there's always a market that's booming for Diageo, but there's always probably one that's having a tougher time. But I find it, again, within the context of the UK stock market, I find it hard to identify, sorry, this is a weak thing to say, but many companies that have greater, in my opinion anyway, predictability and certainty of the relevance of their products, looking ahead, not just 6 months, 6 years, 60 years. It is important, actually. It is important that Guinness is over a quarter of a millennium old. I was going to say quarter. I mean, it's like 260 years. It is important that Johnny Walker has been around for 200 years. It is important that Tanqueray, world's #1 premium gin brand, that's got well over 100 years of heritage as well. I always think, this is another aspect, I suppose, of the way that we try and think about allocating capital. I always like to think, if my family could have the choice of owning 100% of the equity of any business, if our entire family fortune was based on the equity of just one company, what type of company would you want that to be? Assuming that you could never sell. Yeah, you could never sell. Now, it's a trite thing to say. I mean, obviously, I can point to dozens of tech companies that have done unbelievably well over the last 5 years, 10 years. Could you be certain that your family's fortune would be safe in that technology asset in another 20 years or another 30 years? I mean, maybe, but, and I'm not saying that they shouldn't be part of a portfolio, but the idea of aligning your capital, your savings, with the sort of predictability of those key brands within Diageo, it makes sense. It makes sense to me, and I think it is important. I said earlier that the past, in a sense, is irrelevant, because who knows what happens next. It's dangerous to place too much credence or faith in what happened in the past. But there is information, it seems to us, in the wonderful long-term returns that can be earned by owning pieces of these wonderfully durable brands over time. And for my choice, that would continue.
And that makes the next question somewhat redundant, but I'll ask it anyway. Obviously, we've just had unparalleled times during 2020. The UK market has also been under pressure for any number of reasons. How's the trust been holding up over such a short time frame in the overall scheme of things?
Well, for 2020, the net asset value of Finsbury Growth and Income Trust exceeded the performance of the FT All Share Index by about 7%. We were down a couple of percent. The market was down 9%, or something of that order. If you'd told me on January the 1st, before we knew anything about what was looming, if someone had said, Nick, would you be content with outperforming the market by 7% this year? I'd have, bitten your hand off, because, if you can do that, 2 years out of 5, or, over that's where the long-term track record comes from. So I suppose ostensibly, ought to be pretty content with last year. But I'm not sure that I am wholly, to be honest with you. One, and again, we're amongst friends here. That was a tough year. I mean, I found that a tough year. I mean, obviously there were, personal concerns, family and friends being ill. I've got friends who are unwell at the moment. But, just the challenge of, in a set of circumstances that I've never experienced before, what's the correct decision to help protect shareholders' precious capital? And frankly, who knew? I mean, I don't even know who knows now. That's my feeling. There were a number of big positions for us last year. Even though the strategy in the end did better than the market average, there were a number of big holdings that disappointed me last year. I understand why they didn't have a great year, but I might not have anticipated them being as weak as they were. And I mean, Diageo. Frankly, if you described the circumstances of 2020 to me, I might have thought that Diageo, with that incredibly resilient business, very cash, I might have thought that would have done really well compared to the UK. But Diageo was, was down 10%, probably a little bit worse than the market for the whole year. And you don't need to tell me why. The bars are shut. The sports events aren't happening. A company I mentioned earlier, I mean, the single biggest detractor from Finsbury's return last year was Burberry. That ended the year down more than 20%. I get it. I absolutely get it. I'm pleased that there were enough other things that held up to mean that we didn't have a disastrous year for our NAV, but it still hurts a bit when a big holding falls by over 20%. So I have mixed feelings about last year, but there we are. We live to fight another year.
Indeed, we do. And obviously, knowing that you were coming along, Nick, we did ask customers to send in some questions for you. As you can imagine, our post bag, as they say, was fairly full. We certainly haven't got time to go through anything like all of them, but perhaps if we could whiz through two or three, if that's okay, while we've got you here. First question from a customer: you may not consider Terry Smith your principal comparator, but many of us do. Terry has invested in tech stock in recent years and seen his global fund improve accordingly. You still remain tech light. Any thoughts?
It's trite for me to say this, but I will say, we have huge admiration for Fundsmith, and Terry's taken this to a level. I mean, and I think what he's offering investors is so admirable. I really do. On the specific point, I will just confine my comments to Finsbury, which as we've remarked, that is a UK oriented strategy where I'm being measured against the UK stock market, and there just aren't the same opportunities in tech in the UK as are available globally. And I'm not here to talk about our global strategy. Perhaps Michael Lindsay will come and do one of these interviews with you, whenever you want. But there is more pure tech in our global fund. But I want to reiterate, and this doesn't guarantee success, but I just want to reiterate what I said earlier. Over 40% of Finsbury's portfolio is made up of companies that are either definitely already, or we hope will be able to demonstrate that they are using technology in a way that can create substantive new value for their owners. And absolutely, that 40%, and it does include, it does include the London Stock Exchange. I mean, Relex is another major company that's both a major company and a major holding for us. These are globally competitive, substantive businesses utilizing technology to materially enhance the value of their products and services to their customers. And yeah, I'm put it this way. I really want this portfolio to comprise companies that are being advantaged rather than disadvantaged by technology change.
Sure. Okay, thank you. An interesting question, recognizing the kind of overseas earnings influence on the FTSE 100. How will your portfolio be affected if there is a strong rise in the value of the pound?
Obviously that's a hypothetical, and I might just sit astride my high horse here and say, whoever asked that question, I sincerely hope that they never make an investment decision based on their guess about what might happen to a currency, because it's absolutely a losing bet, in my experience and opinion. And we pay effectively zero attention to the volatility or even the direction of currencies, not least because we haven't the faintest idea, but also because, again, in my observation, owning value creating companies is much more important than getting their domicile or the currency that they're measured by right. So, as we speak right now, Diageo is probably down a bit relative to where it might be this year because the pound's strong and people know that Diageo is a big overseas earner, and it does have a short-term impact. But my goodness, would you, going back to this idea about thinking almost dynastically about allocating capital, would you, if your family was lucky enough to own 100% of Diageo, would you sell it because you thought the pound was going to be strong for 6 months or a year? Or no. Own something valuable and the currency will take care of itself. I am going to say something here which maybe is even slightly contradictory from what I've just said, but I say this almost from a visceral gut sense rather than an intellectual one. I think you've alluded earlier, Robert. Richard. I know a Robert Hunter. Forgive me, Richard. The UK has been a tough stock market for a number of years. There are a variety of factors. One of them, though, is that it's been an easy short for global hedge funds. The political uncertainty surrounding the B word, aligned with that big bull market in the United States, has made it so easy to short London stocks and buy stuff elsewhere around the world. What happened on Christmas Eve, i.e. that deal, takes away one of the supports for that let's sell London argument. And I think that let's just say that the question turns out to be a well-founded question. Let's just say the pound does go up a bit because that uncertainty has been removed. Actually, personally, I would expect that we will see global asset allocators and also global businesses keen to invest in the UK, in UK quoted companies also investing in UK industrial opportunities, because the concerns about the currency have diminished. So yeah, let me just complete the thought. I've got a strategic role in our global fund. Linsell runs it day to day, but I've got a strategic role there. I look at the share price performance and the valuation of things we own in our global fund and compare them to similar businesses that we own in our UK fund, and my jaw drops. The gap between the share price performances and the valuations has got wide. Doesn't mean it has to shut today, but there's definitely, in my opinion, a latency in sterling equity assets because it's been an easy short for a long time.
Thank you for that, Nick. And finally, a customer question which contains a compliment. What makes a great fund manager, and how can we as private investors identify those traits that may lead to sustained outperformance?
Luck.
That's certainly a trait.
It's certainly a trait. Markets are always changing, and a danger in what we do at Linsell Train. A danger. You are conditioned by your experience, and all you can do is try and do your best relative to your experience and your judgment, and that may or may not prove relevant in a given set of market conditions. Financial history is very short, a couple of 100 years max. It's not long enough to be certain about winning traits or winning strategies, in my opinion. All you can do is do your best with actually do your best with your own emotional makeup. That's important as well. When we occasionally, every 2 or 3 years, we will hire younger people to come and join our team, and I guess the primary quality, the primary raw quality we're looking for in a young person is simply stated curiosity, intellectual curiosity. Wanting to understand why things have happened the way they are, and just wondering what will happen next. But that's, I don't know whether that's, you definitely can't, as an investor, you can't judge that really very, very readily in a professional investor, and whether that makeup, whether that's relevant for the next decade, I don't know. Maybe out and out appetite for risk taking, maybe that's what you need over the next decade. I don't know. No,
that's a very fair comment. And unfortunately, I have to say that time is now against us. So many thanks indeed, Nick, for your time with us today and for your genuinely valuable and insightful thoughts. And thank you for listening. I'll be back next Tuesday with another Richard Hunter interview. Bye for now.